This video is a Phemex leverage trading tutorial. We're going to go through trading crypto on leverage with this system. It's known as contract trading right here on Phemex. We'll go through this system though and how to actually get set up here, navigate this trading screen, place orders, and how to think about using leverage as well to make sure that we're taking the right amount of risk. I'll leave a link to Phemex in the description. They do give deposit bonuses and offers most of the time, so check that link to see what offers are there for you at the time of watching this video. I'll leave timestamps for all of the sections as well down in the description. We can come to the Phemex platform then, and if you are a total beginner, they actually have a learn platform and simulated trading here, so you can look at a screen and simulate some trades. But contract trading is what we want. So contract, click on contract trading once you have an account, and it comes through to this section. If you don't have an account yet, I've got a beginner's guide that I'll link in the description that goes through getting set up on the platform. Before we start trading crypto futures on Phemex, or what they call contract trading, we have to get some funds into the correct account. So the way that Phemex do it is essentially having this asset right here, which is called US dollar. So they don't have different markets in the futures market. They don't have US dollar tether, US dollar coin, all of the different stable coins. They just have one singular market that they call USD that you can trade against. So if you want to deposit some fiat currency on here, they'll convert it into USD for you. If you have some US dollar tether here, you can actually go over to convert on the right hand side. That's just above my head here, but this is the option when you press convert. And then if you have some US dollar tether here, you can switch it and convert it straight into what they call USD. So that's going to be a 1-for-1. And now I don't think there are any charges there. It's literally just straight into USD because it's going from one to the other. That is what you use to actually go ahead and trade in the contract market, as Phemex call it. What you'll need to do then, once you have some USD in your account, as you can see here, you need to then transfer that out from your spot wallet. So go to transfer and then go over to from spot. And you want to go over to the contract trade account. That's what you want to put it into, and then you can place any amount in there that you want. So I'm just going to confirm that. That's completely free. It goes right into your contract trading account, and you can see trade now, or you can just go back to your spot wallet page. Also, before we start trading, Phemex allow you to open many sub accounts to your account. When trading on leverage and with futures, it's often good to have many accounts because you can segregate your risk. So if you have certain trades that you want to do and you want to segregate them from the other funding that you have, come up to your logo right here or your icon, and then go to overview and sub accounts here. Now you can add a sub account, and you can add a few of these, and it will say main 1, main 2, and so on. And that will essentially allow you to have funds within a segregated account that you can take certain trades with. If they blow up for some reason, it will not affect the risk that you've taken in your other accounts. Phemex allow you to fund your positions in two ways. The first is through USD, which you saw me transfer in. The second is through coin margin. So if you come up to the top right here of the trading screen and then come to which pair that you want to trade, you can see USD perpetual is the main one. You can actually have USDC perpetual as well, but that's coming soon. There aren't any for the time being. There's also coin margin. Coin margin is when you actually use the cryptocurrency to fund your positions. You can see there's only two allowed right now, which is Bitcoin and Ethereum. So let's say you want to take a long position in Bitcoin. You take a futures position on their platform and you fund the futures trade with the value of your Bitcoin. Now, if you do that with USD, you're funding the futures trade with US dollars. Most people will trade USD. You can see the support is much better. The reason being is that US dollars isn't a risk asset, and so everything is valued in US dollars, and so it makes it much easier to fund positions. If you do have some Bitcoin that you're going long with and you're funding a long position with Bitcoin, if the price comes against you, then not only is your trade potentially losing, but your collateral is also losing value. And so it's obviously more risky in that way, but they do have those two options. Most people will fund their futures positions with USD. Now we can choose whether to fund each individual trade or just fund our entire account. This is known as cross versus isolated margin. It's up in the top right hand corner. So you can actually choose this on a per trade basis, but as you can see here, cross 100x. So if we just click on that, this is cross margin. Now, cross margin means you put some dollars on your account and it funds all of your different positions. So if you had $10,000, you can open a position in Bitcoin, one in Ethereum, one in Solana, one in Cardano, whatever, and it funds everything. Now, if one of those positions goes very, very bad, it can potentially ruin all of your other long positions, even if they're in a profit. That's a cross margin for the whole account. If you go to isolated margin, this only funds each individual position separately. So you'll need to put margin on account for the Bitcoin trade, you'll then have to fund a separate Ethereum trade separately with margin that is tied up for that trade. So most people will use isolated. It's a little bit less risky that way, but of course everyone is open to this. If you're a beginner, please, leverage is extremely risky. So, 100x is the maximum, but really anything from, 10x is probably the absolute max that most people will use. Anyway, you can change this per transaction. So most people will have the kind of default that they want for their account. So let's say 3 times margin, confirm. You can change that as is, but isolated versus cross. There's a couple of specific things that we need to know before trading futures as well that happen on every platform. Crypto futures are the same across most platforms, but as you can see here, there's something called a funding and a countdown. Now, this is essentially a rate that you have to pay most of the time anyway, and it keeps the futures price of Bitcoin or Ethereum in line with the spot price. Now, most of the time you'll be paying this, but not all of the time. It actually comes down to what the price of the future is versus what the mark price is. Now, what you can see here is that there's an M here and then the white price to the right-hand side. Now, the mark price is the price of the contract. You can see here the contract's real-time mark price. The mark price may and often does deviate from the last traded price. The mark price is used to calculate profits, losses, and margins. Now, this is really important because you're trading contracts here. Futures are contracts, and so you're trading differently to what the mark price is a lot of the time. It's a very, very small difference, but it does make a little bit of a difference because the mark price is really the official price of the contract that is used for such things like leverage and margin calls and also liquidations if the trade goes against you. So the mark price is the official price that all of those automated things happen with. Now, the actual price here is slightly different because the market can trade a lot faster and changes the price. Now, if there is a difference between the mark price and the actual price, and you can see that here, the actual price, the market's price, is slightly higher than the mark price, as you can see here. If that's the case, that means long positions, so people betting on the price going up, taking long positions, will pay this funding. Now, if the mark price, or if the market price, the real price, is below the mark price, then short positions, people betting against the price, will have to pay that funding. Okay, so that is important to understand, that if you are going long, you just have to factor this into your trades. Now, if you're trading over the short term, it's a very, very small amount and it won't make much difference. But as you can see here, this is a funding which is 0.01%. I think there are 3 fundings per day, every 8 hours. If you multiply that to make an APY per year, it's around about a 10% funding rate. So if you have your funding open, or if you have your position open for a very long time, then just factor that into the position. If it's open for a few days or weeks, it might not make a difference, but it's something to be aware of. Before we get into a sample trading tutorial, just a quick step-by-step guide on how to go through trades, both long and short. We'll look at trading on leverage and how it affects your positions. So as you can see on margin, if you're using margin or leverage, which is all the same thing, what you can do is put $1,000 down and you can turn that into $3,000 to trade with. Now, if you use all of your leverage, as you can see here, the difference between using no leverage and 3 times leverage is a smaller percentage move affects your initial position. So a 10% move with no leverage on $1,000 is obviously $100. But if you're leveraging up, a 10% move of $3,000 is $300. That's a 30% move on your original position. So as you can see, if a 30% move occurs, just without leverage, you make $300. If you're 3x leverage, you make $900 or lose $900. So if we just extrapolate that through, if you have a 33.3% loss on a 3 times leverage position, your entire initial collateral will be completely wiped out. So that's what leverage is. It makes your wins and your losses much larger if you are taking out that leverage. What I would do before trading then is look at the calculator to see how my positions would change. So if you go to the calculator here, what you can do is actually see what the move in price would do. So I would always go to liquidation price here first before any trade. So what we can do is just put in, 100 here. And then the entry price, let's call it 19,000. Now, what's your margin here? You can obviously put this up or down, but we can do calculate right here, and you can see my liquidation price. So this is an estimate, as you can see here, but this is going to tell you that if we're trading with 100 contracts, which are $1 entry price 19,000, what is our liquidation price right here based on how much we have in the account? 15,000. Now, if your trade says that your stop loss should be around 12,000 and your liquidation price is above that, probably not a good trade to get into. It's probably too risky. You want this liquidation price to be way below any stop loss price that you have in. Your stop loss needs to be way above that. So your max potential loss is definitely above your account getting liquidated, because liquidation has other fees and it means that your trade has not been put on properly with the correct risk parameters. So we'll go through putting a trade on now and setting up a stop loss and potential take profit as well. With trading futures then, I'll just go through a very simple process of identifying the trend, identifying some price levels, and then identifying a potential trade with a profit and stop loss level. So the first thing I would do on Phemex, and they give trading view charting, which is pretty much all you need here. Go to indicators, put on some moving averages. So type in moving averages and see those. Scroll down, it's this one here. I'd put 3 on here, as you can see, a 50, 100 and 200. 50 for me, short term. You can maybe go for a 20 period as well. But as Bitcoin and crypto trades 7 days a week rather than 5, I go to maybe a 30 or a 50 here. 100 is mid to long term. 200 is definitely long term. Now, as you can see, the candles right here, all underneath their moving averages. So we're definitely in a downtrend here. So for me, if we're in a downtrend, maybe continue trading with that downtrend. If you have some other analysis that you've done that, maybe there's a news figure that's coming out, or GDP results, or employment, or, CPI, or non-farm payrolls, or something where you think actually the market is not pricing this in, then you can take a different approach here. But really from a trend perspective, very rarely trade against the trend. You can often do that, but usually trading with the trend gives you the best probability of actually putting in a profitable trade. Not all the time, of course, because trends do get broken. But as you can see, all of these moving averages are just going down. And so trading with the trend is the most likely profitable scenario. Although, of course, you have to do your own research with where you think the price will go, whether we've actually got a bottom here. Now, what I would do after that is looking at the trend. We're in a downtrend. I would look at some different timelines and different, times on the chart. So I'd go over to the week, just reset this and see what we're doing here. You can see that the 200 moving average definitely coming down here. We're definitely in a downtrend with the price as well. Now, if you want to day trade, you might want to go to a 3-hour or a 1-hour chart. Maybe have a look at this as well. So just zoom out a little bit and see where you're on the trend. Now, actually, this trend right here is essentially a consolidation. You can see all of the different trend lines are, converging essentially to exactly the same place. So there's a much lower volatility and a consolidation here. From a consolidation comes a breakout. So that's where you may trade futures. Now you have to decide which way that breakout may be and make a bet either way. But with a stop loss and a take profit, you mitigate any risk and potential downside, with your position. So what we can do now is actually look for potential price levels. What I would do is go just to a longer term chart. I always like the day chart to put in price levels. I think there's a lot more data behind those. So I'm just going to reset that chart here, zoom out a little bit, and then we can actually put some price levels on recent price action. Now, price levels that I would call as support and resistance, just key price levels where the price may go to if something happens and we get a bit of data out that moves the market. So I would look for support levels first. Support levels are down areas where the price bounces off. And you can see that right here. This is definitely a price level where there is some support. Now you can actually draw not just a line, but you can draw boxes here as well. Boxes are good just to give an area where the price may bounce to. But what we also want here is a trend line of resistance. Now you can see resistance. You want to go back. Really, this is a trend right here from these last 4 months. So we need to go to the next price level up. Now, what I can see here is that this is definitely a level as well. This is probably a shorter term level. The reason being is because we can see that there are many instances where the price bounces off these levels, right? So there's a support level here, and it did it twice and 3 times. And then we obviously went higher, but we can see again, the price bounces along this price level many different times. So that's why we say a support level. So if that's a support level and you're bullish and you think we're going to change momentum here, that would come into taking your stop loss level. So that would give you a price level where you put your stop loss. And then up here, you can see the price moves into this resistance a few times and gets rejected. So you can say if you're a long position here, this would be a good position target to take profits because you're looking at previous levels where the price meets resistance, and so you can trade around that. Now from those key price levels, we can determine how much risk we're taking in a trade. So what I can do is go to the left-hand side and choose either a long or short position. I'm going to show you a long position right now. And then what I want to do is go down to the 6 hour, because if we're trading shorter term, we probably want to look at a shorter term trend to actually get some proper price levels here. The day chart is fine if you're trading a little bit longer term, so that's all up to you. So I'll just change that. So how do we want to trade these two price levels now? We can go to long position here. And the price right now is around 19,268. So we'll have to do that long position now. Now what we can do is say, let's say we want to take a long position. We can see, what the profit and loss is. I would say that I would take profits just below a resistance level. And to be honest, at opening a 19,000 trade, maybe 20,000, maybe making $1,000 out of the trade. If you think that we're going to get some good news for the market, you could do that, just before the resistance level. And then down at the bottom, what's your stop loss? At what point, if the trade moves against you, if you're going long, you're betting on the price rising, at what point does the price get to a level where you think, I've made a mistake and the price is going lower? For me, that would be, as you can see here, probably around this level. You can see a couple of spikes down, this one here and this one here, where the price gets sold off, but then buyers come back in. And so I would say or suggest that that's probably a good level just to put your stop loss. You don't want to get stopped out on a wick, as you can see these. You want a little bit of buffer in there. You don't want to get stopped out by those wicks, but if it moves lower than that, then maybe there's been a breakdown and you have to get out. So you can look at this now, say maybe the target is right here. The risk reward on this trade is 1.5. That's absolutely fine. I'd say anything above 1.25, 1.2, maybe 1.3 is probably good. Anything above that is great. And obviously we don't know where the price is going to go, but based on previous support and resistance levels, if there is a bullish move, we could suggest it would go up to this level around 21,000. So that would be a risk reward here. Now what we have to do is look at the price levels, our max potential drawdown, which is our stop loss, and understand how much we can actually go ahead into the trade. If you want more info about trading futures and also day trading and many of the different techniques, I can't go over them in this video. I've got some free guides down in the description. I'll link them there. My crypto investor course has an entire futures and day trading section, as you can see here. It's laid out step by step, very short videos that just go through every single step of the process. You can see that all here. I update the course as well for free for existing users, so check it out if you want. But what I want to do now is look at the opening price and the stop loss price. So what I want to do here is this position. We know the opening price is, let's call it 19,200. So we'll go 19,200. And then the stop loss price, well, we've got that from our technical analysis. Our stop loss is around, let's call it 17,800. So we can do that. 17,800. Now, how big is your account? You can put anything in here that you're trading with. Most traders will not risk more than 2% of their portfolio per trade. That's up to the individual trader. If you're very confident of a trade, maybe put it up to 5% or something like that. Doesn't really matter, right? It's up to you, but 2-3% per trade. Let's say 3%, we can calculate that we can go ahead and trade 0.214. So we can go over here and we can go size 0.214. Now, how to use leverage with this? Well, as you can see, the leverage is isolated 3x now. What this means is we are using 3x leverage on the current amount of dollars that we have. So leverage really just lets you put less down. That's my opinion anyway. So instead of saying, I'm going to get $1,000 in my account and I'm going to leverage it up 5 times, the max amount I can trade, what professionals will do is say, what I can do is know that I can risk 2 to 3% of my portfolio in a trade, and the leverage allows me to put less down initially. So I don't have to fund the whole thing. I can put 30% of it down, right? Because we're leveraging 3x. Now, what that allows me to do later on is if the trade is going in my favor and I think actually things are getting better, I could potentially even add to the trade because I still have leverage left over. What you can do here is, let's say the price goes up here, is then move obviously the entry price and then move the stop loss up. Your initial trade is essentially de-risked at this point, and you're taking extra risk. Now, you are increasing your entry price because you're buying it higher if you're going long, but that's that. If the trade is moving in your favor, maybe you want to eke out a little bit more of the trade, but using the leverage for me gives you options later on rather than just leveraging up and taking more risk. That's how I would do it anyway. So what we can do right here is go to advanced, and you can see bracket order. I would put that on. Choose how much that you want to trade into and the price. As you can see here, a bracket order is using that take profit and stop loss. As we know, the stop loss down here was 17,800. So you can definitely put that in here, 17,800. And the take profit is this level up here around 21,000. You don't have to have a take profit in there. You can just let it ride if you want as well. But the stop loss is always recommended when using leverage because we need to know what our max loss is in order to make sure that we're managing our risk properly. A short position is the exact opposite of this. This is when you sell first, high, and buy back later low. So it's the exact opposite of a long trade, which is what most people trade. Futures allow you to trade short, whereas you can't do that in the spot market. So what we can do is go to this here, short position, and it's exactly the same. Now, a short position is where you actually sell first. So you're looking to buy back lower. If we're buying back lower for a profit, that means if the price rises against us, that's not good for us. So what we need here is to look for a price level where we want to get out. I would suggest that previous short-term resistance levels you can see here, 1, 2, and 3 here. This is where the price kind of meets a little bit of resistance. If the price gets up a little bit higher than that, we might have got our trade wrong. Now, in terms of the profit target, very difficult for a short trade on this one because essentially we're at very, very long-term support if you go back to the chart. And so there's really no price level that it could go to. The only way that I would have a short trade here is essentially just to say, well, if we do get a breakdown, we'll probably go to some sort of recognizable level like 17,500 or something like that for a short-term trade. So you could put that in if you want to go short. And it's exactly the opposite. Instead of going long here, we'll actually just go short. So the exact same amount, you put your opening position in, you put your stop loss in, which would obviously be higher at this point, how much risk you want to take, and then go short position first. So that's very easy. And now the take profit would obviously be lower at a lower price because you're going short, and the stop loss would be higher because if the price rises against you, that's your trade in a loss. So you can do the limit price here, or you can do a market order, whichever one, but it's a short position that you're going in here with a take profit at a lower price. If you want to know more about trading with limit and market orders, if you don't know that, again, the beginner's guide is in the description. The Crypto Investor course does have way more trading strategies and much more in-depth analysis of trading. So if you are interested in that, I'll leave that link in the description. Also, Phemex link down there as well. They often give deposit bonuses, so check that out when you're watching this. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.